The world's most important oil choke point is effectively closed to normal traffic. Yet a screened trickle of tankers is still moving, and at least 2 passage fees were reportedly settled in Chinese yuan. That does not mean the dollar is collapsing. It means China has built a route for buying sanctioned oil without relying entirely on dollar clearing. But money is only half the story. Before the crisis, Beijing also spent a year filling storage tanks. This is how the yuan and an estimated 1.4 billion barrels became China's 2 oil shields. Before the war, roughly 20 million barrels of oil and petroleum products crossed the Strait of Hormuz each day, around a quarter of the world's seaborne oil trade. After American and Israeli strikes hit Iran at the end of February, normal traffic collapsed. A limited number of screened vessels continued to move, but the route became dangerous, expensive, and unpredictable. Oil prices surged. War risk insurance multiplied. Some carriers and insurers withdrew from the route entirely. For China, the world's largest crude importer, this was not only a supply crisis. It was a test of whether years of financial and physical preparation could actually work. Why does paying in yuan matter? Because oil's financial network still runs mainly on dollars. After the 1973 oil shock, American-Saudi economic and security ties helped reinforce dollar pricing. But no secret treaty ordered the world to use it. The system won through scale. Benchmarks, loans, hedges, and reserves clustered around dollars because everyone else already used them. That network gives traders deep markets and reliable financing. Oil did not create dollar dominance, but every energy purchase helped reinforce it. That access gives Washington leverage. Many cross-border dollar payments pass through American correspondent banks or through institutions exposed to United States jurisdiction. A sanction can freeze an asset, block a transaction, or make a foreign bank choose between one customer and access to the dollar system. Iran and Russia therefore had a practical problem. They still had oil to sell, but using the dominant payment route exposed the trade to American pressure. Settling in yuan reduces that dependence. The payment can sometimes clear without a United States correspondent bank. But it does not create immunity. Ships, refiners, exchange houses, and front companies can still be sanctioned. The yuan changes the route. It does not erase every checkpoint. Here is the part most coverage misses. China did not prepare only by building an alternative payment route. It prepared with physical oil. During 2025, China added an estimated 1.1 million barrels a day to storage. By December, its combined government and commercial inventories were approaching 1.4 billion barrels. The second shield was not digital. It was already sitting in the tanks. That number needs context. The United States Energy Information Administration estimates that about 360 million barrels were government-controlled. Roughly 1 billion more sat in commercial storage. Comparing that combined total with only the American Strategic Petroleum Reserve would be misleading. On a government-only basis, the two countries began in a similar range. Even so, China's full inventory was roughly 4 months of typical crude imports. The estimate is imperfect because Beijing does not publish complete figures. But it explains the advantage. Refineries could draw from stored oil instead of chasing every expensive cargo as soon as the crisis began. China did begin drawing from inventories as imports fell, but the stockpile was only part of the explanation. Refineries reduced output. High prices discouraged purchases. Domestic fuel demand weakened, and export restrictions kept more refined products inside China. The stored crude made those choices easier. China could reduce immediate buying without creating an instant nationwide shortage. That probably eased some pressure on the global market. Every barrel China did not urgently bid for was available to another buyer, but it would be wrong to say China's stockpile stabilized prices by itself. emergency releases, lower refinery demand, and recovering Gulf exports also mattered. China did not escape the oil shock. Its inventories simply gave policymakers something scarce during a crisis: time. Other countries bought time by opening emergency stocks. The International Energy Agency coordinated a release of 426 million barrels, by far the largest in its history. That amount was equal to roughly 4 days of global oil consumption. The United States committed the largest public contribution, 172.2 million barrels. Its Strategic Petroleum Reserve stood near 415 million barrels before the crisis. By the week ending 7th August, it had fallen to about 299 million, its lowest level since early 1983. These countries did not empty their reserves, but they spent a meaningful part of their buffer to soften a shock that inventories alone could not solve. Now the financial shield becomes real. The United States Treasury says Iran primarily settles oil sales in Yuan, while China buys roughly 90% of Iran's oil exports. Iran can then spend those yuan on Chinese goods. Russia built another corridor. Officials say more than 99% of bilateral trade is settled in rubles or yuan. China's CIPS network averaged a record 920 billion yuan per day in March, and at Hormuz, at least 2 reported passage fees were settled in yuan. It was not universal, but it proved the route could work under pressure. But this is not a new dollar. The yuan represented about 2.7% of payments recorded by SWIFT, and under 2% of disclosed global reserves. The dollar held more than 57%. China's capital controls also limit how freely global investors can move money, and currency cannot remove tanker, insurance, or sanctions risk. The Petroyuan is powerful in a narrow role, keeping selected trade moving when the normal dollar route is costly or blocked. The petrodollar is not being overthrown, it is gaining an exit lane. China can sometimes buy sanctioned oil without relying directly on American dollar clearing. Its inventories then give it more freedom to decide when to buy, when to wait, and how much pressure it can absorb. That is the real lesson of the crisis. The yuan and the stockpile are not separate stories. One keeps trade moving, the other gives China time for that trade to work. So what do you think? Is this the beginning of a true Petroyuan system, or only a powerful workaround for countries under sanctions? So there you have it. That's what it turns out to be. If this answered a question you didn't know you had, hit subscribe so you don't miss the next one. And if you liked it, tap that like button. Turns out, it actually helps a lot.